I'm Charlotte McLeod with the Investing News Network, and here today with me is Alain Corbani, Head of Mining at Finance SA and Portfolio Manager for the Global Gold and Precious Fund. Thank you so much for being here online with me today. Great to see you again.
Thank you very much, Charlotte. It's a pleasure.
Great. So we're going to start off with some recent news because we had the U.S. Federal Reserve's latest meeting this week, and I want to get your thoughts on that. So it seems like some of the key takeaways there are that tapering may be sped up. We might see as many as 3 interest rate hikes next year. What are your thoughts on that? Does that sound like a reasonable timeline to you?
Okay, this is a great question to start the interview. What the investor must understand is that with Jerome Powell, there is no surprise, and we have been told for weeks, months, that tapering was coming. And we were told way in advance when tapering would be triggered. And then we were told how long this tapering was going to last. And then we were given notice that actually, instead of starting at the end of 2021 and ending in the summer of 2022, because of inflation, we might, and growth, a lot of growth in the economy, much higher than what we thought, that maybe we should shorten the time frame for this tapering and increase our purchases of assets. And this is exactly what happened yesterday. I mean, this was the case in November, this was the case in December, so we are not surprised. And in a nutshell, you mentioned those 3 rate increases in 2022. If you listen carefully to Jerome Powell, if you did listen carefully, if the audience listened carefully to what he said, he didn't commit on those 3 rates. He just mentioned those plots. You know, everybody's talking and wants to look at those dot plots. And those dot plots, yes, do mention 3 increases, but everybody knows that those dot plots are not reliable. So, and the president of the Federal Reserve has told you many times, don't rely on those plots. So we still want to focus on them, and the market has priced those three interest rates increases. But the reality is that we don't know, and the Fed, they said it yesterday very clearly, they didn't have any position on those rates. They want to increase the rates. We know that. Of course, they want to increase them. But the question is, will they? And they didn't discuss the timing of those rates. So we have to be very careful not to take for granted what has been very carefully telegraphed to the market.
Right. So let's take a look at what could happen going forward. So all of this is kind of an aid of the Fed is changing its narrative on inflation. First, we heard about how it was going to be transitory. Now there's this more aggressive action. They've dropped that narrative. What do you think inflation is going to look like in 2022, especially given what we heard this week?
Okay, this is... I feel like saying that we have to be again down to earth and look at what the numbers are telling us instead of speculating. The reality is that indeed, from transitory, we are understanding that we will have more pressure on prices for a longer period of time. And this is a fair statement, and I don't think that we should really challenge this statement. So let's go with that vision that inflation will be stickier, will be persistent over the next 12 months. And this is a very important point, because the reason why gold went down in 2021 by about 5-6%, and gold mines did worse than that. They are They are down year to date by 17%. So the reason why gold went down, it's because of that tapering. The perception or the consensus back in early 2021 was there is tapering. With the tapering, that implies higher rates. That makes sense. And since inflation is transitory, the impact on real rates would be positive. So we will suddenly be in an environment where real rates were going to increase. And we know that real rates, negative real rates are positive for gold, and increasing real rates are negative for gold. So the reality is that we had this tapering, it's taking place, but there's a big but, inflation might not be that transitory after all. That's the first point. So yes, there will be inflation and it will be sticky. And you can look at all the indicators from the different regional Feds, Cleveland, Atlanta. They are all telling you that, you know what, we're going to have some inflation for a foreseeable future. Let's get used to it. But there's a big difference between the sticky indicator of inflation and those that are much more volatile. So let's focus on the sticky part. And the sticky part is showing about 2.6% of PCE, which is the favorite indicator that the Fed is using. So we are using 2.6%. And by the way, this is what the Fed, the number they used yesterday in their forecast for 2020 and 22.
Okay, so let's talk a little bit more about gold's performance this year, because I know among our watchers, our audience members, the big question is why we haven't seen a better price performance from gold in 2021, given the factors that they think should be working in its favor. So if you could go into that a little bit more and give your perspective.
Okay, so for gold to perform, we're going to make it simple. We need the US currency to be weak, and we also need real rates to be negative or to be on the decline. And this is not what we had in 2021. And this is not definitely on the US dollar front. And on the real interest rate front, the reality is that we were expecting higher rates. We didn't really have them, but we were expecting higher nominal rates, and the expectations for higher nominal rates related to the tapering program would have triggered an environment negative for the price of gold. And this is what happened, and everybody was positioned for this scenario. So again, higher real rates, a higher US dollar, that was the recipe for a lower price of gold. This is changing now. This is changing now. And this is what the audience needs to understand. What we had in 2021 is not going to be repeated in 2022.
Right. And let's go into why you think that's the case, because I think definitely that's what people want to hear. They want to know why next year will be different.
It's because very few people understand that at the end of each quantitative easing, we had QE1, we had QE2, we had QE3. Now we are in the start of the beginning of the end of QE4. Each time quantitative easing ended, each time rates went down. So what you need to understand is that it's not because quantitative easing is going to end that this will translate in higher rates. It's the opposite. So quantitative easing, per the language of the Fed yesterday, is going to end in three months. At the end of the quantitative easing 4, rates will go down. And if we still have this inflation, this sticky inflation around us, we will have a negative impact on real rates. As for the US currency, we do believe that, yes, a lot of investors prefer the yield of US treasuries to the Japanese or the European yields. Yes, there is an arbitrage that is being taken place. Yes, there is demand for the US dollar, but the macro numbers of the US economy are not leading us to believe that the US currency can maintain this strength. The dual deficit, the twin deficits, the money supply, the debt to GDP are taking directions that have never been seen before. So if you look at the United States in their environment, you cannot have a stronger US dollar because the underlying equation is telling you we need a weaker currency. Now, let me just explain to you one more thing. The reason why the dollar is strong, it's because there is inflation. Assuming the pressure on prices goes down or becomes, we enter a disinflation period, then the American government will be, the Treasury basically will be able to let the currency go. Right now, you cannot have an inflation, a CPI or a PPI or a PCE at double-digit numbers, or the PCE at 4 or 5%. You cannot have those numbers and at the same time have a weaker currency. You are heading to catastrophe. So we have a stronger dollar because we need to contain this inflation. Once the pressure on prices will diminish, then it will be time for the US dollar to weaken and start again its trend, which is meant based on the fundamentals of the economy, of the aggregate of the US economy will have to weaken. So 2021 was tapering and stronger US dollar. 2022 will be end of quantitative easing, which means lower rates and the start of a weakening US currency because inflation pressures will diminish.
Right. So if you were to sum up your outlook for the US economy in 2022, how would that sound like?
We'll have it's impossible to be to have a position that is not optimistic. I mean, we had a historical growth rate in 2021, and we are going to have a deceleration in 2022 of this growth rate, but we'll still have a growth rate above the natural growth rate of the US economy of the last 2 decades. So we'll have growth, we'll have some inflation, but we will not have higher rates. And we will not have higher rates because let's just think 1 second. Historical growth rate in 2021. Unemployment that is almost close to full employment. Inflation rate that we haven't seen in decades. And nominal rates at a 50-year low. So 50-year low. So the market is telling us that they don't believe that the growth rate is going to be sustainable, or that inflation is going to weaken, or, and this is the worst case scenario, the intervention of the Federal Reserve will trigger the next recession. And this scenario, that's why I started by I'm optimistic for 2022, because we have the chairman of the Federal Reserve who triggered in 2018 the 20% stock market crash. So That's only 3 years ago. And this man remembers it. And his mandate is to make sure that the stock market remains calm, that we need to reach the dual mandate of the Fed. And this is exactly what's going to happen. That's why I said no surprise with Jerome Powell, none. He will not shock the market, and he will make sure that everything he does is telegraphed months and months in advance. So higher growth, lower growth, but still strong and healthy growth in the economy, lower rates, I maintain these lower rates, and probably a disinflationary environment.
Okay, now you told me before we got started speaking here that people were right to be in gold. Gold is going to do better in 2022 than it did in 2021.
Yeah.
Can we talk a little bit more about the outlook there? I know things that the Fed says are very important to gold, but are there any other factors that you're watching in terms of the yellow metal?
Well, what we have noticed is that the demand for ETFs in 2020 was strong, very, very strong. And we had a wonderful year in 2020 for gold and gold mines. 2021 was the opposite. Because of this tapering, as we mentioned many times in this conversation, and because of a stronger US dollar, institutional investors favored base metals, favored investments towards some growth, and basically the net position in ETFs went down, and it went down sequentially in the first quarter of 2021, second quarter of 2021, and third quarter of 2021. They were all negative quarters, but the amount that was sold kept diminishing. So from an annualized Q1 of 220, 250 tons negative, so sold in the market in ETFs, now we're down to 80. And if you look at the recent numbers, the weekly numbers, the tide has turned into positive territory. And this is indeed responding to the fact that the market believes that rates are not going to go higher, that the tipping point is at 160, 150 on the US, 10-year US, 150, 160, 170, you name it. But that, again, the fundamentals are turning back in favor of gold. So there is demand for ETF now. That is positive. That wasn't the case a few quarters ago, not to mention the last quarter. And basically, what the competition of gold and crypto, if you recall, I mean, how many times I've been asked, Alain, what do you think of crypto versus gold? And Alain, why don't I arbitrage my gold position for crypto? The reality is that these two assets are frankly so different from each other. And a very famous strategist described those crypto as, the last speculative trade in this cycle of the economy. And I truly believe that if crypto weakens further, it will attract more people towards the gold, towards the gold space. So that's another, minor, very minor, marginal topic, but there is no doubt that if crypto loses some credibility, that credibility will favor the gold space. I'm not saying that the Bitcoin is going down 20%, 30%. I'm not saying that. I'm just observing that there was an arbitrage that took place in favor of crypto over gold. And with that discrepancy of performances, maybe we'll see a reversal of that trade.
Okay, yeah, definitely that makes sense. And for 2022, I don't know how you feel about price predictions, but are you looking at a specific range for gold next year?
Listen, I don't, but we have to be, again, down to earth. Expecting gold to move by 20% is is really, for me, something that is more than achievable. And the reality, if you look at some historical performances, whether it's gold mines versus the Wilshire 5000, whether you look at the gold to copper ratio, I mean, we are trading today at levels that saw gold mines increase by 100% from these present levels. So I am definitely positioned, and the portfolio is positioned in a growth mode. And that growth mode is toward achieving a 100% return. Now, if we have, let's be very blunt, if we have a 100% return on gold mines, we should have a 20 to 30% increase in the gold price. So $22, $23, $2,500 in the price of gold at the end of 2022 is very achievable. But again, I have one chance out of two to be right.
I remember when we spoke this time last year, you were pretty happy with how the gold stocks had performed. So let's talk a little bit about how they did in 2021, which was a year where the gold price itself did a little less well.
Yes, absolutely. So gold went down by 5.5% in US dollars. Gold mines went down by, if you take the numbers from yesterday, was down 18. They were down 18%. So the leverage of the gold mines versus gold did play out with no surprise. That's number one. Number two, gold mines can only perform well if gold performs well. The correlation between gold mines and gold is around 80%. So if gold goes down, gold mines will go down. If gold goes up, gold mines should go up. But this time, gold went down and gold mines went down in sync, and this was more than logical. But gold mines now are confronted with another hurdle, and it's inflation. So, and we've said it for 3 years now. In that cycle, there was the first part of the cycle that was focused on restructuring balance sheets, focusing on return on equity, and demonstrating that in an environment, friendly environment for gold, those gold mines could be profitable. And this is exactly what they did. And then now we are moving into a second phase in that cycle. And this is the growth phase. And in that growth phase, we are going to focus on growth, and meaning that having a healthy balance sheet is not enough to be rewarded. Having a profitable operation is not enough to be rewarded. Distributing dividends is not enough to be rewarded. You will need to show growth. And this is when it becomes tricky. So what does it mean? It means that gold mines couldn't use their operating costs to improve their efficiency anymore, because so many years of underinvestment turned into new years of catch-up investments, and their break-even point went up. And to increase their margins, to increase their profitability, they will need a higher gold price. So where it becomes, as I said, tricky, it's because not only we need a higher gold price, but we also need them to be very, very, very disciplined in the control of their costs. And unfortunately, we've had a few disclosures recently of mining companies basically facing inflation in their cost that reach 20, 25, 30% for some of them. So this is not the right direction. This is not the right direction. So the market will be, I believe, much more selective in the way it rewards those mining companies. Now, having an exploration company or with an asset that has reached a pre-feasibility study or a preliminary economic study, will have to demonstrate that those numbers are reliable. It won't be taken for granted anymore, because literally now the perception is whatever number you show me, I'm going to add 20 to 30% on it. And this is how I think the market is going to behave. The market will reward the producers that are disciplined, the producers which show growth that is accretive, and the explorers and developers who have assets that are not marginal, So that if profitability has to be reviewed downward, it is still an affordable and a profitable asset that they can monetize. Otherwise, the latitude to reward everybody because price of gold goes up, I think, is not in the cards anymore in the short term anyway.
Okay, that's very interesting and really important points, I think, for investors to keep in mind heading into the new year. As we're wrapping up here, I just wanted to ask if there's anything else that you would want to put on investors' radar as we move toward 2022, anything that you would want them to keep in mind.
They will have, for those who are trying to understand where gold is heading, they will have to see where rates, nominal rates, let's forget real rates, it's maybe too complicated for some people, but the reality is that if nominal rates don't move up like a lot of investors, like the consensus is expecting, this will be the reason why gold will perform well.
Okay, great. Well, thank you so much for being here. Great as always to talk to you, and hope to catch up with you again soon.
Thank you very much, Charlotte.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Alain Corbani of Finance SA.